NVIDIA has printed more millionaires than a Reddit YOLO trade. If you missed the 2023 rally, let's be real. You probably felt like the guy who sold Bitcoin at $100. But it's 2025 now. Does NVIDIA still have a golden ticket? Or are you about to FOMO into the most overpriced graphics card in history? By the end of this video, you'll know if NVIDIA is still a rocket ship, or about to crash harder than Cathie Wood's ARK fund in a bear market.
This is like common sense. The more GPUs you buy, the more money you save. That's right, the more GPUs you buy.
Yeah, Jensen, that's what my brain tells me when I'm adding another GPU to my cart at 3 a.m. But let's be real, at a $2 trillion market cap, are we the ones getting saved? Or just the exit liquidity for some hedge fund's yacht upgrade? When something goes that vertical, at what point do we stop calling it a bull market and start calling it Jenga? Because sooner or later, someone's gonna sneeze and the whole thing might come down. I mean, sure, NVIDIA's making more money than a Vegas casino, and AI is the hottest thing since Bitcoin in 2021. But we've seen this movie before, right? Wild hype, stocks flying, everyone convinced this time is different. And then? Well, that's what we're about to find out. Is NVIDIA an AI bubble waiting to pop? Or is this just the beginning of something way bigger? Because if this is Jenga, I want to know who's pulling the first block and who's still stacking more on top. So let's break it down. NVIDIA's revenue, margins, and future growth. Are we still going up, or is gravity about to kick in? First things first, NVIDIA's market cap is sitting at a mind-blowing $2.65 trillion. Yes, trillion, with a T. For reference, that's bigger than the GDP of Italy. NVIDIA could literally buy an entire country if it wanted to, assuming countries were for sale. And no, you can't buy Italy on eBay. But market cap alone doesn't tell the whole story. We also have enterprise value, EV, at $2.62 trillion. Quick lesson. Market cap equals stock price times shares. Enterprise value factors in debt and cash. Since NVIDIA's EV is slightly lower than its market cap, it means the company has a solid cash position and minimal debt dragging it down. That's a green flag. Now, let's talk valuation multiples. Trailing PE, 36.99 forward, 24.27. What does this mean? Trailing PE looks at the past 12 months. At 36.99, NVIDIA is still pricey, but hey, it's better than the 70-plus PE it had last year. Forward, PE looks at future earnings. At 24.27, it's way cheaper than before, meaning Wall Street expects NVIDIA's profits to skyrocket soon. Translation, NVIDIA is growing into its valuation rather than just being pure hype. Is it dirt cheap? Numbers are getting fairer? Absolutely. Now, one of my favorite underrated metrics, the PEG ratio, price, Josh earnings to growth. NVIDIA PEG ratio equals 1.05. What does this mean? A PEG ratio of 1.0 is considered fair value, meaning NVIDIA's price is in line with its expected growth rate. PEG under 1 equals undervalued PEG, over 1 equals overvalued. So at 1.05, NVIDIA is slightly above fair value, but not crazy overpriced. That's actually really good, considering how fast it's growing. Think of it like this. You're at a steakhouse. The ribeye should cost $50, but it's $52. Would you still buy it? Yes, because it's still a damn good steak. Same logic applies here. Now, here's where things get a little spicy. Price to sales equals 20.67. Price to book equals 33.45. Wait, what? These numbers scream premium pricing. Price to sales at 20.67 means investors are paying $20.67 for every dollar in revenue NVIDIA generates. That's expensive, even for a high-growth company. A reasonable PS is usually below 10. Price to books at 33.45? That means NVIDIA's stock price is 33 times the value of its net assets, after liabilities. Translation. If NVIDIA were a house, you're paying 33 times what it's worth on paper. Now, Does that mean it's a bad investment? Number tech companies don't trade based on book value. They trade on growth. Would I want a lower price to sales and price to books? Yes. But am I surprised NVIDIA is trading this high? Not at all. EV revenue equals 20.08 EV EBITDA equals 30.43. These are premium numbers, but for a company dominating AI, gaming, and data centers, it makes sense. What do these mean? EV revenue of 20.08 investors are paying 20x NVIDIA's annual revenue to own the stock. EV over EBITDA of 30.43 EBITDA, earnings before interest, taxes, depreciation, and amortization, is a proxy for profitability. 30x EBITDA is high, but normal for high-growth tech giants. If NVIDIA were a boring old factory, these numbers would be terrifying. But since it's an AI juggernaut with insane margins, investors are willing to pay a hefty premium to get in on the action. Now let's talk about profitability. This is where NVIDIA truly obliterates the competition profit margin. 55.85% NVIDIA keeps over 55 cents of every dollar in revenue as pure profit. Compare that to other tech giants. Apple, 25% profit margin. Microsoft, 35% profit margin. NVIDIA, 55.85%. This is one of the highest profit margins in the entire stock market. NVIDIA isn't just making money. It's raking it in like a casino on a winning streak. Here's where things get even crazier. Return on assets, 57.42%. Return on equity, 119.18%. What does this mean? Return on assets of 57.42%. For every dollar NVIDIA owns in assets, it generates 57 cents in profit. Return on equity of 119.18%. For every dollar of shareholder equity, NVIDIA more than doubles the return. Most companies dream of hitting an ROE of 20 to 30%. NVIDIA is at 119%. That's unheard of. Bottom line, NVIDIA is absurdly efficient at turning assets into profit. Now, let's talk revenue and net income. Because NVIDIA isn't just profitable, it's growing like a beast. Revenue, $130.5 billion. Net income, $72.88 billion. Let's put that in perspective. That's a 55% net margin, meaning NVIDIA turns more than half of its revenue into pure profit. Compare that to Amazon's net margin, 6%, or even Google's, 25%. NVIDIA is in a league of its own. Translation, NVIDIA isn't just a fast-growing company, it's an absolute profit juggernaut. Diluted EPS, $2.94. Earnings per share shows how much profit NVIDIA makes per share outstanding. Why does this matter? A high EPS means strong profitability. As NVIDIA keeps growing, this number will likely surge higher, making the stock even more attractive to investors. Now, let's look at NVIDIA's financial strength. Total cash, MRQ, $43.21 billion. Total debt and equity, MRQ, 12.95%. Why is this important? NVIDIA is sitting on a massive $43.21 billion in cash. Its debt-to-equity ratio is only 12.95%, meaning it barely relies on debt. Bottom line, NVIDIA is a financial tank. It could pay off all its debts tomorrow and still have billions left over to invest in AI, data centers, and R&D. Levered free cash flow, $44.17 billion. Translation. After paying all expenses, NVIDIA still has $44 billion in cash flow. Why is this important? Massive free cash flow lets NVIDIA reinvest heavily in AI, research, and acquisitions. It also means big stock buybacks and potential future dividends. For comparison, Tesla's free cash flow, $6 billion. Microsoft's free cash flow, $20 billion. NVIDIA's free cash flow, $44 billion. Investors love companies with huge free cash flow because it means sustainable growth. So, is NVIDIA still worth buying? If you're a long-term investor who believes in AI, NVIDIA is still the undisputed king. If you're worried about valuation, waiting for a pullback makes sense, but timing the market is risky. What do you think? Are you buying, holding, or taking profits on NVIDIA? Drop a comment below. Don't forget to like, subscribe, and hit that notification bell. See you in the next one.